Hi, my name is Paul, and welcome to my stock portfolio series, where I started from scratch and invested $100 each month into Canadian securities for 2 full years. In this episode, I'm going to review how my portfolio has progressed throughout 2023, comparing my investment performance against some popular ETFs that are good alternatives to selecting individual securities. Plus, I'll also be going through the big winners and losers of the year. My goal with this series is to emulate the situation of a hypothetical Canadian who will never be able to max out their TFSA. So this series is, in essence, designed as an individual case study that follows the entirety of an investment journey, starting with $100 and eventually ending in financial freedom, which I define as being able to afford all of one's expenses as well as having a little extra for fun, all sustained by the portfolio. At which point, the hypothetical Canadian will be able to happily retire and live off of their investments, and I can end the series. And while this will take probably a few decades at minimum, I believe that this goal can be achieved by following a simple but consistent investment plan. Now, first things first, I am still going to be following the same set of rules for investing within the portfolio in 2024. Those being that only $100 can be added to the portfolio each month, I can only make trades on one day each month, only Canadian securities can be purchased within the portfolio, no derivatives are allowed at all, and the market capitalization of any security traded must be greater than 300 million Canadian dollars. If you're interested in learning more about the rule set, I have a whole document linked in the description box that breaks down the goals and rules in much more detail. Since last month's episode, the portfolio's holdings didn't really have much news come out aside from GoEasy, who announced that they would be renewing their normal course issuer bid, allowing them to repurchase up to 10% of the company's current shares outstanding. Though they didn't repurchase any shares under last year's NCIB, and I don't know that we should expect any changes to that trend in 2024. So with that, let's take a look at how the portfolio's holdings performed over the last year. And we'll start with the smallest of the portfolio's long-held positions, MTY Food Group, which is a company that owns about 90 different restaurant banners, including Cold Stone Creamery, Famous Dave's, Papa Murphy's, Wetzel's Pretzels, and many, many more. Throughout the year, a lot has happened with the company, who completed 2 major acquisitions for the ownership of Wetzel's Pretzels and Barbecue Holdings Group, which opened up some additional expansion opportunities. However, the industry is still being negatively affected by some of the lingering impacts of the pandemic, as well as the higher rates of interest, which have cooled some of the exuberance that was baked into the stock price shortly after the announcement of the acquisitions. So it's been a bit of a roller coaster year for MTY, which quickly ran up about 25% before dropping, rallying, dropping again, and as of recently, it's been headed back upwards. But it is still down about 7.5% from where it started the year. That said, I don't think that the stock deserves to be trading this cheaply. The company's trailing 12-month price to free cash flow is currently below 9, and the company's capital expenditures are expected to be significantly lower throughout 2024. Plus, MTY owns several quality restaurant banners that are set to continue growing despite the current economic headwinds. Noting that, the company does have some challenges to overcome, including a large debt pile due to the recent acquisitions, and some of their weaker banners weighing down the franchising growth, in addition to the previously mentioned economic challenges like higher interest rates and inspection and construction backlogs. Still, MTY Food Group was a company that I bought fractional shares of every single month last year, and with its track record of being able to swiftly and efficiently pay off debt, I think it's highly likely that the company will perform quite well over the long run. Moving on to the larger of the 2 long-held positions is the Morguard North American Residential Real Estate Investment Trust, which, as the name implies, is a REIT that owns and rents out over 13,000 apartment units in the United States and Canada, mainly located in major cities and growing urban areas. And unlike MTY, the Morguard North American Residential REIT's year was much more smooth and steady, with average rents consistently increasing and occupancy remaining relatively high. But despite the solid operating performance, the market has shown very little favor towards REITs post-pandemic, and while Morguard's 2023 price performance started off promising, partway through Q1, the price started to slide, and while the share price has since rallied a little bit over the past month, shares are still down about 12.2% from the beginning of last year. But again, I think that the underlying value of the shares are significantly misaligned with the current price. So while shares are currently trading at $14.72, those shares are granting the holder ownership of over $49 net of all debt, worth of quality cash flowing real estate that has a history of selling above appraisal price. And the cherry on top is that the REIT's management is aware of this discount and they've been buying back shares to lock in the difference for shareholders. The one drawback is that the company does have some major renovations to complete over the coming quarter, and with the now higher interest rates, Morguard will not likely be able to continue repurchasing shares without some form of financing. Personally, I don't think that this is a huge issue since the management could always just wait until these large garage renovation projects have been paid for, and then they can resume the repurchases once the capital expenditures are over and done with. Or alternatively, they could just sell a property to come up with the necessary funding for the buybacks. That said, there is also a risk that interest rates could continue to rise, which would make repurchases even more challenging as the REIT's mortgages roll over into their higher payable APRs. And like MTY, I bought shares of Morguard in the portfolio every single month during 2023, and I still expect that the gap between the net asset value and share price will close, and hopefully that should provide shareholders with some very nice gains in the process. Next, we have Knight Therapeutics, which is a company that I have not talked about in quite a long time on the channel. Knight is a pharmaceutical company that licenses, markets, and distributes branded generic and innovative drugs mostly within Latin America, though it's based out of Canada. And the reason I haven't talked about the company in a while is because I decided to completely sell my stake back in April and May of last year for an average share price of $4.67, which is about 13% below where the shares ended the year. But I don't regret selling, since it was clear from the start that I didn't fully understand the business, which made it hard for me to have conviction in my investment. So when it turned out that there were new competitors entering the field and that their presence would negatively impact Knight's already low operating margins, I came to my senses and realized that Knight didn't have as strong a competitive advantage as I'd originally believed, and that this weakened position contradicted my investment hypothesis and reduced the growth potential of my invested capital. So my only real regret here was investing in a company that was outside of my circle of competence in the first place, which I should make clear is an error on my part. Knight Therapeutics may still be a good or even great investment, and I can assure you that based on their actions, the management team is of good quality and is aligned with the shareholders' best interests. My issue is that I'm simply not qualified to judge the quality of a pharmaceutical business, or any other medical business for that matter, and so I'll be steering clear of the entire sector going forwards. Thankfully, despite taking some licks on my Knight Therapeutics investment, I more than made up for it with my decision to reinvest the money, plus a little bit extra, into GoEasy. GoEasy's business involves lending money to people who have a subprime credit score through the Easy Financial and Easy Home brands. Now, GoEasy has been on my radar for quite a while because it's been such a strong compounder with excellent margins and a really strong management team that is focused on improving the quality of service for its borrowers. But despite a great track record, GoEasy's year started out pretty poorly on account of the Canadian government stating their intentions to further reduce the maximum allowable annual percentage rate on loans to 35% in order to push out predatory lenders. But knowing that GoEasy is an upstanding, reputable company that offers flexibility on its loans and actively tries to improve the financial situation of its borrowers, this struck me as an opportune time to buy shares, since the future was likely to be less competitive. Plus, the company's average APR on its loan book was already well below the newly proposed maximum, and on top of that, the regulations weren't expected to be put in place for a good while. Also, they wouldn't be backwards looking, so prior loans made at higher rates would not be affected by the new regulations. All this led me to believe that the company was being unreasonably discounted due to fear. After all, it's not every day that you can pick up a company that grows its annual net interest income by over 25% for a PE of around 11. As it would turn out, the market agreed, and after the company posted strong Q2 earnings, the share price has been soaring, and now it's over 60% higher than where I bought shares. The only unfortunate thing is that I didn't have enough time to build a slightly bigger position in the monthly portfolio before the stock raced way beyond the bounds of what I felt comfortable paying. Now, this one does of course have some drawbacks, which is why I was hesitant to pay more than 12 times earnings, despite its exceptional growth. Aside from the potential for further reductions to the maximum allowable interest rate on loans, the company also is in the stage in its life cycle wherein it's utilizing debt in order to grow as fast as possible. This has led the company to take on considerable debt, which it then re-lends to people with a history of poor credit. This naturally lends itself to significant risks should the economy take a turn for worse, since GoEasy's customers are probably more likely than prime borrowers to default on their loans. And if that happens at a large enough scale for a long enough time, things could end in bankruptcy for GoEasy, which is a pretty serious downside risk, even if it is somewhat unlikely. Reflecting back on how the portfolio looked at the start of 2023, back then the total value of the portfolio's holdings were worth about $1,457, with Morguard's shares making up roughly 72% of the portfolio, and M2I Food Group and Knight Therapeutics making up the remaining 17% and 10% respectively. Tracking these exact holdings over the last year, they would have earned a cumulative $44.16 in dividends. But they would have lost about 19.4% in market value. This would have resulted in a one-year loss of about 16.36% when factoring in the value of the dividends. So, if I decided to pause my investing at the start of the year, the results would have been far from ideal, requiring a 25% increase to get back on track to hitting my goal of a 12% annual rate of return. However, throughout the year, I was able to take advantage of some of the lower prices by continuing to buy shares. Plus, I completely sold out of Knight Therapeutics and added a position in GoEasy, so the portfolio looks quite different now than it did at the start of last year. Instead of only having a portfolio worth $1,400, it's currently worth over $2,300, and the portfolio is only down about 6.2% in total, which still isn't great, but this is a substantial improvement over the last few months, as you can see on this chart. The green line here represents my portfolio, and this graph tracks the performance net of contributed capital, and how my money would have performed if I'd instead invested in some popular ETFs. As of recording this, the S&P 500 has the top performance over 2 full years of tracking, bolstering a return of over $345. In second place is the Global Value ETF, with a gain of over $287, which is followed by the 2 Canadian ETFs that put up gains between $150 and $200, and then lagging behind the pack is my portfolio, which is currently down $78 on the $2,400 that were invested over the last 2 years. As for that bright red line with the stars that's constantly going up at a steady exponential rate, that marks where my portfolio would need to be in order to keep on track with my goal of a 12% annualized rate of return. Needless to say, I'm quite far behind at the moment, with my portfolio needing about a 13% gain just to get back to where the goal line is. But if I get a couple more months like December, we could be there in no time at all, because these sorts of big swings, both upwards and downwards, can and do happen, and they should be expected whenever you invest your money in the market. Even more so if you have a heavy concentration in just a few individual companies, like I do. So it's crucial that you're able to parse out whether or not these price moves are justified. And the best way to do that is to have a good understanding of what you're invested in. Whether it's something a bit more passive, like a diversified ETF that allows you to own a little piece of everything, or a specific business in a niche industry. Either way, if you don't know when to be worried and when to be relaxed, your internal monologue will be guiding you blindfolded, randomly urging you to take gains or cut losses at every bump, jump, or standstill. But if you know that what you're invested in has a long future runway of growing its current cash flows unimpeded and is trading at a reasonable discount to the future profits, then you probably won't be scared off if the company misses a few analyst expectations, or feel the need to take your gains and run just because the price goes up 20% in a short period of time. Personally, having a strong understanding of Morguard's microeconomics allows me to clearly see its discount, which prevented me from selling out when the company hit its lows, and it was even an encouraging force for buying more shares during the dip. And even now that the price has recovered, it's still very clear to me that there's a long way for the stock to go. And so I'm going to start off the year by buying 5 more shares of the REIT. Then I'm going to put the rest of my monthly capital into MTY Food Group, which is also trading a good bit below its fair value. I will not, however, be buying any more shares of GoEasy this month because despite the company's massive growth potential, I'm also aware of the risks that the company faces. And in the $150 range, I think that there are safer investments that I'm much more certain will have good outcomes. That said, I'm not going to sell my shares since I do still think that the company will perform well over the long run. So by keeping GoEasy as a small position within the portfolio, I'm reducing the risk of losing a large chunk of my investment capital while also benefiting off of the company's strong growth. And that's my plan for this month. So let's hop into the Wealthsimple account and buy some shares. Okay, so we're here inside the Wealthsimple account. It's Friday, January the 5th, and I'm going to be buying some shares. I have $106.29 in the portfolio. $100 of that is contributed, $6.29 in dividends from last month. So let's get started with Morguard. I'm going to do 5 shares of that. And the remainder is going to go into MTY. It looks like we have $32.69. Okay, and I'll see you back when that order comes through. Okay, I'm finally getting a chance to record this part about a week later than intended, and I'll explain the reason for that at the end of the video, but just know that everything before the share purchasing portion of the video was based on data after the market close on January the 4th, and that everything going forwards is based off of data from the market's close on January 5th. So I apologize for being later than expected, but hopefully circumstances won't have this happening again for a long while. Now, about an hour before the market's close on Friday the 5th, I received an email confirming that I'd successfully bought 5 shares of the Morguard North American Residential REIT for $14.72 each, in addition to 0.594 shares of MTY Food Group at a cost basis of $55 even per whole share, leaving my portfolio with no cash left over after my orders had been filled. So, as of the market's close on Friday, January the 5th, the portfolio has 112 shares of the Morguard North American Residential REIT worth roughly $1,673, about 9.5 shares of MTY Food Group worth just over $525, and the same 1.62 shares of GoEasy, which are now worth approximately $254. Heading over to the dividend tracking chart, in December, all of the dividend income came from the Morguard North American Residential REIT, which paid out $6.29, and that closed out the dividend earnings for the year at $63.22, which is about how much it costs to fill up a car at the moment. So the dividend income is still far from being able to pay for the average Canadian's cost of living, but this is only the second year of this hypothetical Canadian's investment journey, and it is a big step up from last year's $17.11. In fact, this is more than 3.5 times 2022's earned dividends, and things are only set to grow from here, with February's payout expected to be $8.15 coming from both Morguard, who pays out monthly, and GoEasy, who pays out quarterly. This will be a new record for dividend earnings within a single month, but it should be short-lived since the month afterwards we get dividends from Morguard and MTY, which should be even more money. Plus, I'm expecting both MTY and GoEasy to announce dividend hikes towards the end of Q1, which should be paid out in Q2. So, in the next few months, we're likely to see some really strong dividend growth. This will allow me to reinvest even more money each month, which will then lead to more dividends and continue on in a compounding cycle. Though it should be noted that dividends are not the only way to make money investing. And if the option to invest in a quality company that I understand well comes up and it does not pay a dividend, I would still happily invest in it. But I digress. If I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no dividend hikes happened and no shares were purchased, I would now expect to receive $98.63 over a 1-year period, which is a 127% increase over last year's $43.39. And this leaves the portfolio's yield on contributed capital at 3.95%. So that concludes 2 years of investing $100 per month into Canadian securities. If you're interested in keeping up with the series through 2024, this is the planned release schedule for monthly series videos. So you can always make a note and check back later, or if it's more convenient, you could just click the subscribe button and the bell icon to get notifications for when my videos come out, which might be the better bet since I'm already starting the year about a week after I'd hoped to have this episode released. Now, at the end of last month's video, I explained that I'd be traveling back home from visiting family with my girlfriend on the 6th, so my planned release on the 7th was already expected to be delayed until the 8th or 9th. However, as fate would have it, about an hour into our drive back home, our car's check engine light started flashing and the gas pedal stopped working. Luckily, we were able to get to the shoulder of the highway safely, and we were also able to get towed back to a mechanic's where we found out that the car wasn't likely going to be worth the cost of the repair. Unfortunately, this delayed our trip back home by a couple of days, and when we finally did get back, our top priority was on finding a replacement vehicle. So we spent the next few days at different dealerships testing cars, comparing our options, and negotiating prices. Anyway, I'm sorry for the late video. But as I've said before, sometimes circumstances that are out of my control do come up. I'm just thankful that no one got hurt, and when all was said and done, we got a decent price on a car that hopefully will last us the better part of a decade. So thanks to everyone for being patient, and before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing with anyone else who may also benefit from it. Thanks for watching all the way to the end, and enjoy the rest of your day.